Hello, and welcome to the first Resilient Talks, Facebook Live Ask Me Anything event from Resilient Wealth Planning in our California office. My name is Victor Gaxiola. I'm the investment advisor representative within the Resilient team. And to my left
is Kim Gaxiola. I am a certified financial planner and also financial advisor, part of the team. And we've been doing this for quite some time now. So thank you for attending and asking your questions.
Yeah, so we'd like to welcome, of course, all of you who are joining us from the, what we'd say, Legacy Tecro Financial family that has now come together with the Resilient Wealth Planning family that was out of Wisconsin in the Midwest. We just want to let you know that as a collective team, we thought it was important for us to get in front of all the news cycle and the information that's going out there and the things that you're seeing in the marketplace to proactively present, our views and answer any questions that you may have. Now, to that end, as we put in the invitation to this Facebook Live event, if you do have a question, please send it to text 408-560-4505. And that was also on the email invitation that went out earlier today, as well as the description of this event in the Facebook Live. So 408-560-4505. The other thing that is important to note is that today's session being live without, any real slides or any additional material, we of course are prepared to discuss a number of different items. Some questions did come in a little bit earlier, so we'll be able to address those. But just remember as a disclaimer, this should not be construed as an investment advice. Obviously, you'd want to consult with us as your primary advisors or with your own advisors when it comes to making any specific decisions. And of course, anything that we say could be different tomorrow. The world changes quickly, so it's hard to predict in the direction that things are going. So the best we can do is that any of the views expressed, any of the things that we express is based on our experience, based on our observation, and of course, based on listening to various analysts and economists and other people that we trust and listen to on a regular basis as it relates to having a position as to what to do during this kind of market.
And just to give you some background, we did a lot of these during COVID because the information was changing so rapidly, and there was, as we can all look back at now, see how varied that information was and how inaccurate a lot of times the information is. And so we do feel like there's a lot of information out there today with what's going on in our current market environment. And there's also a lot of misinformation that's out there. So we just want to get ahead of it and answer any of your questions that come up.
So again, 408-560-4505 for any questions. That goes through to our behind the scenes guy, Lucas, who's part of our California team.
Hello.
Who is monitoring, of course, the stream as far as any questions that may come up, and then be able to address those. But I think that first and foremost, I want to say that it would be natural for people to feel nervous when you start seeing the financial markets doing the kind of ups and downs that we've been experiencing lately. Post the announcements on tariffs, of course, the market reacted negatively to the news. And even today, if you took today as a snapshot of the kind of volatility you can experience during times of uncertainty, the market started strong at the beginning, started to taper off into the afternoon, and I think it actually closed down for the day. So you can see how there's quite a bit of swings that are taking place in the market, a lot of it which is driven by the news cycle, a lot of it is based on speculation, a lot of it is driven by algorithms and institutional investors. The fact is that, and you probably heard this from a number of different sources if you've been paying attention to the financial news, is that the market was, for the most part, pretty overvalued to begin with, and sometimes it just needs a catalyst to start pushing it over the edge, at least to get to a point where the volatility that we've experienced. But I do think that the top question that we've been getting from the calls and emails we've been receiving from a lot of our clients is really just a question about, understanding what tariffs are. It's something that not too many people have a deep understanding about. So I would say that maybe the first question we'd like to address is what are tariffs, and specifically why, what impact are they making to the financial market? So Do you want to kick
Okay.
things off with that?
Yeah, I'll start. Just to let you know a little about my background is I studied economics in college, and back then tariffs were a dirty word, and everyone liked free trade, and everybody was talking about NAFTA and how exciting that was going to be. So now you know when I was in college. And so tariffs, to put it simply, are just a tax on goods that are coming into the United States. Um, all other countries have tariffs on our goods that go out to their countries, and we have not had very many tariffs on products coming in to access the U.S. markets. And so that is what the current administration is trying to do. And to let you know, this is not a new situation. We have had some tariffs that were already introduced into the market back in the original Trump administration, and those tariffs continued on during the next administration with Biden. So it's not new. There are more of them that are coming, and quite simply, they're there to protect domestic industries. They're there to encourage local production and generate government revenue. And so times have changed. While I can say, I was talking to my sister a few months ago, or no, a couple days ago, and she was saying, what do you think of tariffs? And I said, I studied free trade. I think it's a phenomenal idea, but that means that everybody has to be playing by the same rules. And previously, we were playing by those rules, but not many others were. And so I think it has to be fair and balanced. What is there? And from a larger perspective, part of what tariffs are is a tax that generates revenue for the U.S. government. I think we are all in it together and can agree that our government has far too much spending. We can't balance the budget, and it's time to really focus on our finances as a country. And tariffs is a way to bring in revenues, to increase revenues for the U.S. government. And hopefully that means that they can take a little bit of pressure off of us as taxpayers and be able to lower our personal income tax in the future. So that is how I understand the big picture.
Yeah, that's true. I mean, taking a macro view of the entirety of tariffs, it is our understanding, and based on the resources that we have at our disposal, that this is the first of a number of different initiatives and steps that I think our current administration is looking to improve, the fortunes of Americans in general, from the standpoint that if it is a tax on these imports, I think the main goal here for the U.S. government, specifically to what Secretary Bissett is focused on, is really looking for ways to create a better balance between us and our trading partners, and to rectify some of the imbalances that have existed before. If nothing else, it definitely is showing a serious side of our approach to this, taking on more of an American first policy. Being apolitical in this, I think the truth is that we're looking at ways to raise revenue, negotiate better terms with our trading partners, of which a lot of this had already gotten started. Our main trading partners in the United States are Canada to the north of us, Mexico to the south of us, and China. So those are the three main trading partners. I think that since the announcements, since the changes, I would expect that in the next couple of weeks or so, if not sooner, that a number of our trading partners will be willing to get to the negotiation table to find things that are much more equitable to the interests of the U.S. or fair and equitable to both countries. And then in the end, if we do see some improvements in those trading partner relationships, at least it's a move in the right direction and better than we were before. Mm-hmm. So I think part of that is part of the driver. The other driver, I believe, too, is trying to create an environment which would be a lot more conducive to local or domestic manufacturing, or finding ways that we can bring industry back to the United States already. I think in some of the negotiations with Taiwan, specifically I think it's Taiwan Semiconductor, is looking at building additional plants in the United States. We saw one just outside of Phoenix in Arizona, which is pretty impressive. So if there's a way that we can bring more manufacturing in state, and if tariff is a catalyst to drive that, I think that's part of the initiative here.
Mhm.
So
So, shall we begin with a couple of questions that have come in?
yeah, absolutely.
Okay, so I like this next question because this means somebody is being an opportunist here. What types of investments would benefit in the current environment?
It's a really good
I-
question. Well,
I
yeah, what
I
would
know,
you say?
and I
We might have
heard
different
this-
opinions
I have
on this.
heard this come in quite a few times, and I would say, unfortunately, I'm not going to give you an answer right now, only because I think it's too soon to tell. That really is my answer. Everything that happens because of tariffs, such as, the corporations investing a lot more money in manufacturing here in the US, is going to take time.
Mhm.
And so none of this can we expect to have happen overnight. I see the whole stock market bounces, volatility going up and down and sideways and up and down every day as a vote for uncertainty, because the stock market does not like uncertainty, and we are all uncertain at this moment. Corporations are uncertain at this moment, and it's going to take corporations and financial analysts at those corporations a while to crunch the numbers and see what they do differently. It also will take us as consumers, US consumers, a while to see the effects on prices when we go to the grocery store or the retail store or when we purchase things. And we will be constantly making changes in how and what we purchase based on the information we're given at that time. So, I could say, for instance, we're interested in buying a car this year. Before I would say maybe I was going to buy a car coming out of Asia, but I might think twice about that now and go for an American car because of that. And so we'll know when we go car shopping, but we're not going to make a decision until that time. So it's very uncertain right now, and we are constantly analyzing, reviewing what's going on and patterns in consumption. And we'll be making any changes that we need to make over time as we see it.
I think that,
fruition.
yeah, and I agree with you. I mean, I think businesses see this as an additional business challenge, obviously, to supply chain management as it relates to consumer sentiment, consumer purchasing patterns. And so as we're all digesting the news and seeing what the impact is going to have, it's not unlike, how they embrace both challenges and opportunities. In the last couple of years, for example, a lot of what's been driving the market in 2023 and 2024 has been the adoption of artificial intelligence and looking at AI as a way that they can be much more efficient. That in itself was an opportunity, but it was also a challenge. And so here we move into another one. And so whereas a lot of the focus and attention and conversation has been around tariffs, its direct or indirect impact, if you will, to stock market pricing is what we're starting to experience now. Now, obviously, the tariffs could take a while for all that to get sorted out, but the impact that it's having on stock market pricing creates both opportunities, but it also creates concerns. The thing that we would love to be able to share with everybody and for everybody to understand is this isn't our first rodeo. I mean, we've seen movements and things like this in the past. We've have been battle scarred as advisors with the pandemic, with the dot-com bust and boom. We've seen the housing crisis of 08-09. We've seen 9/11. We've seen a lot of different things that have had a major impact, if you will, on the financial markets.
And I'll say beware of herd mentality when it comes to investing. And this is why we don't take an immediate reaction to things, is because typically the first couple trading days after significant announcements that cause the markets to move does not create the most opportunity. And so, there will be herds of people saying, oh, let's get in right now to, that stock that has greatly depreciated in value. We don't know if that's as far as it's going or not yet. And I like to always say it's important not to catch a falling, you don't catch a knife when it's up in the air, because you don't know how far it's going to go and it might cut you. And so we are very cautious about that.
Yeah. So again, if you've just recently joined us on the Facebook Live, the number to text any question you may have is area code 408-560-4505. Lucas is here monitoring any questions that might come in. One of the other conversations that I've been having with people as we've been doing a lot of the investment reviews for our clients during this spring was doing a look back. It's typical and it's very natural when there's volatility like we've experienced, that people start thinking in percentage basis as, oh, I'm losing this and the market's really dropped. Well, we're probably trading right now at levels that we were trading at about a year ago, if not less than a year ago. And so it's really what we've experienced most recently. It's like a recency bias. It's easy to be extremely negative when your measure is only 3 or 4 days, but if you stretch it out much longer and you start looking at what the last 5 years have looked like, you can see that the S&P 500 as our main barometer of the stock market has actually done very well. So if you go back to 2020, so this is in the throes of, during the pandemic or so, at the end of the year, the S&P 500 closed at 3,756, so 3,756. Now, keep that number in mind, okay? 3,756. 2021 was a great year in the market just because there was a recovery that happened in a post-COVID world. Supply chains got started. There, the S&P 500 ended the year at 4766, nearly 1,000 points higher in 2021. And then 2022 came about. So all was not rosy, and the stock market and the S&P 500 dipped. It actually experienced an 18% negative return in 2022, or a drop. So it ended the year at 38.39, slightly above where it had ended in 2020. And then the last 2 years, 2023 and 2024, were outstanding years. So 2023, we had nearly a 26% rate of return on the S&P 500. Then 2024 was about 23% in 2024. So if you combine 23 and 24, you're looking at 26 and 23%, nearly 50% returns. The end of the year, 2024, the S&P 500 closed at 58.82. Okay, remember, 2000 was 37.56. 2024 was 58.82, nearly 2,000 points higher over a 5-year span.
And what I like to always say is, just as much as you can't believe the value of your account when the market drops 20%, you can't believe the value of your account when the market goes up quickly too. This is, it's always a value in time. And so you have to be patient, and we don't get good years without bad years.
That's true. And remember, this is just talking about the S&P 500, so it's the entirety of the S&P. It's not looking specifically to the individual ownership. Like, we have developed our own equity models, which have individual stocks, mostly rising dividend stocks, and which we're monitoring constantly and making modifications throughout the year. Same thing applies on our bond side with bond funds and taking a look at the bond picture. And so, the results that we get in our models are different than if you were just measuring it against the S&P 500, because the way we design our models is such that you participate on the upside, but when we're experiencing markets like we're experiencing now, it's to protect you on the downside. And for those clients of ours that are in distribution mode, which is to say that they're living or at least deriving some of their income from their portfolio, where we're trying to maintain as much of that principal as possible, we proactively removed or put aside anywhere between 3 to 6 months of expenditures in cash to be able to weather through the kind of volatility we're experiencing now. So, like I said, not our first rodeo, and it really is a series of just recognizing human behavior and impacts that are taking place. I mean, if it hasn't come across, I'm not overly concerned. I'm always cautiously optimistic about the direction things are taking. But I do think that this was something that was somewhat predicted in some ways from the standpoint that, you know, President Trump ran on a campaign that he was going to make some changes with an American First policy. Early this year, a lot of the discussions were his negotiations with Mexico and Canada. Now, they didn't go very well, but they probably, hopefully, will go better now. Now they've expanded that tariff conversation, and the market's just reacting to it.
So we have one question that came in: how do I protect my portfolio for future inflation? And since I was the economic study, I'm going to talk about this because this is the one that bothers me when people talk about inflation and tariffs in the same sentence.
Okay.
Because inflation, as we all should know what it is, it meant that prices were going up every year. And over the past few years, we have been living, prices going up. Every year they go up a little bit more. That is, inflation is the rate of increases in prices. Whereas a tariff is a one-time tax. So we would expect prices to go up from this tariff, but we don't expect them to continually go up in the future. And so it's a one-time impact, one that we can all adjust to, and how we spend our money and what we purchase. And, I even, was looking at some statistics from manufacturers here. If you were to build an American car here in the US, but you use a few of your inputs are from overseas, the price of those inputs may go up, but it's not going to make the car price go up exactly the same amount as those inputs, because labor, you would account for labor and you would account for all these other things. Sometimes the actual inputs may only be worth 10 to 30% of the price of making that good. And so it's not a direct apples to apples. The price, tariffs go up 25%, that means everything's going up 25%. Some of that will be burden, or some of that will be absorbed by the company, some of that will be absorbed probably by us, but it's not a direct reflection of what we're going to see in price increases. And it's a one-time adjustment.
I think part of that, in kind of closing off a little bit of the talk on tariffs, is that it's a little too soon to tell. And the guidance, if we could provide some guidance, is not to have this knee-jerk reaction. Now, like I said at the beginning when we first got started, it's natural to be nervous. And obviously, if you are nervous, we want you to be able to sleep at night. So if you're one of our clients, we definitely want you to reach out to us and our team so that we can have that conversation, perhaps review your account, see how it's positioned and what modifications might be necessary, just so that you can sleep at night. But like I said, we're not, I think we need to give this some time to kind of bake into the market, which is, one of the questions that I'd received, I'm just looking at here, which was, there was some curiosity as to whether or not this current environment is likely to lead to the Fed dropping rates, because they had anticipated, I think in the last Fed meeting, there was some discussion about the Fed possibly dropping rates. Now, it's hard to tell. I think that one of the other stories, or one of the narratives that isn't really being discussed as much, because so much of the focus is on tariffs and so much of the focus is specifically on its impact to the financial markets, to the stock market, is that the United States is carrying a very heavy debt load. As a matter of fact, statistically, I think it's $6 trillion in debt that is maturing this year in 2025, and so the U.S. government needs to find a way to refinance that. And the fact that the market has taken an adjustment on the equity side, we're starting to see a lot of movement also on the bond side, on the area that is deeply impacted by interest rates. And so I think it's important to note that there's this, kind of inverse relationship between the equity markets and the bond markets. And what we're seeing is that as the bond yields are starting to go up or down, are they going down or up?
The yields are going down.
They're going down. Right. You got to remember.
Yeah. Flight to quality. Everybody buys bonds when they're scared, and when prices go up, yield goes down.
Yeah. So as the yields on those bonds go down, the price of the bonds start going up. So it's like this inverse relationship. And so if the U.S. has a huge bill to pay, which in this case is $6 trillion in debt, and they're able to refinance that debt at much lower rates, that equates, when you're talking in trillions, into billions in savings in trying to reduce our deficit. And so that is, I think, a lot of what the strategy is. Tariff is the first a stage in I think a much longer term strategy. I think that part of what the administration is also looking at is ways of being able to reduce taxes, repatriate manufacturing, bring it back to the United States, and some of the other, and it's just one of, a number of initiatives that they're trying to do to both reduce costs and then increase revenue. So the Department of Government Efficiency is very deeply involved in this. And we have a lot of people who were executives in the private sector who are currently involved now in the government, in the public sector, and bringing their best ideas to it. So, and innovative ideas. And so I just say, let's give it a little time.
Yeah, we should all be wishing them well.
Yes.
If we
Hope for the best.
If the government can raise revenues and decrease their expenses, we get closer to a balanced budget. And I think in the end, we all will benefit from that over time.
So I don't know if the Fed is going to drop rates. I would hope that they would actually just keep them unchanged and let the dust settle a little bit before taking any proactive action in that. They may not need to.
Yeah, and keep in mind, the Fed really is only about short-term rates, and we are seeing the 10-year rate change even without any change in what the Fed does. And so that is market-driven sometimes, and it has been market-driven lately. Yeah. So another question: should I stay invested?
Well, what I would say is don't make a knee-jerk reaction. I mean, especially for those individuals that we work with that are still working, and if you're still contributing to a retirement plan at work, or if you're still in a growth mode for your nest egg, sometimes these are the best times that you can pick up some very quality stocks or investments at a lower price point, or if nothing else, pick up a greater quantity of those shares in your existing portfolio. So I would say yes, stay invested. However, of course, everybody's situation is different. And so in those cases where you do need cash or you need liquid assets, or like I said, if you can't sleep at night, then that's when we would want to have a conversation.
Yes, but the short answer is don't do anything in knee-jerk reaction to the volatility, and have the conversation with your advisors, and make sure that your actions are based on logical reasons for that and not on emotional investing.
Yeah, the markets have a long history of having events that have taken place over the course of, for centuries, but definitely in looking at the last 50 years or so, there's a number of events that you could attribute that have led to double-digit drops or triple-digit drops in the Dow or what have you in the market, and yet we always have a way of getting out of it. We transition out of it. Sometimes it could take a week, sometimes it could take a month, sometimes it could take a year. But the fact is that if you pull back and take a look at the valuation, if you look at the S&P 500 or the Dow over the course of 20, 30 years or so, and you stretch it out, we always experience new lows and new highs, but they're higher lows and higher highs, and it's just a question of having the patience. This is why we very, very, very strongly recommend that when it comes to ownership of equities, that you're owning quality. We call them our no-drama stocks. The rising dividend stocks, for those of you who work with us, know that it's a portfolio where you recognize 80 to 90% of the names in your portfolio. So from a full transparency standpoint, you know what you own. But by the same token, when this is one of those things, when there's an event like this, it's like the tide. It's going to move all the boats, right? But some boats are going to stay, stable and shipbound and ready to go and face the choppy waters ahead.
So, any other questions that we...
Lucas, anything else?
Not seeing anything.
Okay. Well, again, this was our first, what we call Resilient Talks, Facebook Live Ask Me Anything event. I have a feeling it may not be our last. We will continue, obviously, to monitor the situation on a day-to-day basis. For For those of you that are working with the Resilient Wealth Management team, or Wealth Planning team, I'm sorry, Wealth Plan, I'm still getting used to saying the name, it's right behind me. For those of you who are used to or are working with our team and want to have a conversation, please reach out to us. The best way is just to pick up the phone, or you can go to our website and contact us. If you're not working with us and you are interested in learning more about our process, learning more about our team, learning about how we're helping investors and families save for retirement and plan for their short-term, mid-term, and long-term goals, please reach out to us. The best way to do that is to go to the website, which is resilientplanning.com. You can also email me at victor@resilientplanning.com. Happy to have a conversation and an initial discovery meeting. We'll monitor to see whether or not we get additional questions after the fact. You can still continue to use that number, 408-560-4505, even if you're watching this in a replay. And all I will say is we'll see if we do another one. If we do, we will announce it on our Facebook page. So we encourage you that if you are interested and this was useful for you and you're not already following us on Facebook, please go ahead and follow. That way you get notification if we do decide to do another one of these. Plus, we occasionally share a lot of content that we think is important. We curate it and then send it out to our clients and the people that are part of our page. We also have a presence on LinkedIn at Resilient Wealth Planning, and we also have an Instagram account, which is Resilient Wealth Planning, so you can find us there. And you'll see the logo that's right behind us.
Yep.
But on behalf of the team, Lucas, Carolyn, the whole team in Wisconsin, myself, Kim, we want to thank you for joining us today. And like I said, we're here for you in case you want to have a conversation.
We understand it's always a little different because you're always in a different place than you were in the last time there was a market drop like this. Some of you may be closer to retirement. Some of you may now be in retirement. And so it feels a little different.
Mm-hmm.
But we have worked with clients in all phases of their life. And this one, isn't a black swan. We knew what was going to happen in terms of it wasn't a secret that tariffs were coming. And so we're prepared to handle what comes our way and yours.
So thanks again for joining us, and just reach out if you have any questions. So thanks, and we hope you enjoy the rest of your week.
Yes.
Take care.
Bye.